friends, now let me start with your last day revision. Let me just tell you that this particular video, you should be seeing it only on the day before the examination. See, generally you are getting 1 day holiday before the examination, and I'm assuming that on that particular day, you are at least going to study for 12 hours. At least that you are going to study for 12 hours. Plus you have one half day, which is the day which you have already completed before the after the earlier examination. So roughly about, I assume that you are going to study 4 hours on that particular examination day, and on the holiday day you are going to study about 12 hours, and on the day of the examination in the morning, maybe 1 or 2 hours that you are going to study. Roughly about, I am telling you, you have 12 hours plus 3 hours, that means your previous day of the holiday, and 2 days, which is of the 2 hours, which is of the day of the examination. So roughly about, I'm just telling you about 12 plus 5 hours, approximately 17 or maximum 18 hours that you are going to study. Okay. Out of this particular 18 hours, friends, I am going to take you not more than about 3 hours or so. Okay. So this particular video, friends, when you're going to see it, I will try to keep it very short, and I will try to make it very concise, and I will try to make it very much to the point. I will, as far as possible, friends, not going to exceed more than 3 hours, because see, when I'm started the class, I don't know exactly how much time that I'm going to take, but roughly I will try to limit myself. And during the video, friends, I will also give you instruction that, okay, you pause this particular video at this point in time and refer these all questions which you have done it in our classwork or in our homework section, or etc, etc, etc. So roughly I'm telling you that out of your about 17 to 18 hours which are available, effective available hours before the examination, roughly you dedicate 6 hours. 3 hours this particular class which I'm going to take, plus 3 hours or so which I'm going to guide you that you do it by yourself, these points. That means you follow my instruction on this particular video, and I guess that this should be more than sufficient. The balance hours, friends, you do it by yourself, because ultimately the best revision is something which you do it by yourself. So sir can only help you to an extent, but the best thing which you can help is only to your own self. Okay, so the balance hours is just left to you, and let me just get started in the quickest possible manner. Friends, let me start with the important topics and the important discussion immediately. First of all, let me straight away go to the business income and the other points. First of all, friends, if you want, you can pause your video here at this point in time. You first of all refer all your rates of tax, all your special rates of tax. In the special rates of tax, friends, I already told you that on-off provisions, that in certain provisions, chapter 6 a deduction allowed, in certain provisions return filing is relaxation, basic exemption is not available. So your rates of taxes, the calculation of the tax liability, friends, in variety of situations which I have already showed it to you, like for example, tax liability calculation of the private trust, public trust, partnership firm, corporate assessee, your special rates of tax in the international taxation, plus resident person special rates of tax like 115 BBE rates of tax, 115 BBDA, 115 BBD, all these kinds of provisions, just have a glance of it. Okay, so first of all, focus on your rates of tax, your tax liability calculations in all the different variety of the chapters that I already explained to you, that you should know it absolutely. Second thing, friends, if you want, you can revise your all the basic business income adjustments, like for example, variety of the business income questions we have already solved. You please go through what all adjustments, like basic adjustments, like for example, cash expenditure. It is so basic, but you should just have one final glance that, oh, these are all the hardcore basic adjustments with respect to the business income. So this much you should do it. If you want, you can just pause it here and complete this much of revision by yourself. Then, friends, if there is any dedicated question in the business income, and if there is any question which is relation to section 33AB, that is your growing manufacturing of tea, coffee, rubber, remember the steps. The first of all, you have to do all the basic adjustments. That means all your basic business income adjustment. Then you have to do 33AB. Then you have to do agricultural income, and thereafter you have to do this particular set off. Here the sequence of doing the adjustment is extremely important, friends. If you miss out this particular sequence, if there is a question on 33AB, then you are going to be a very big loser. If you want, you can just pause this particular video here. Then the couple of questions which you have already solved on section 33AB, some dedicated questions, just have a glance of that particular answer. If you come 133AB question, friends, which you have already solved and which you have already understood, where the answer will look like this, that you start with profit as per P&L, do all the adjustments, and do second adjustment is 33AB. After doing 33AB, you have to do the agricultural income. In this particular question, the set off was not there, and that's the reason we have not given. In this particular question, one of the most important thing was, in case if there is any income which is purely agricultural income, for example, if there was any income which was only because of the growing manufacturing of the tea or rubber or whatever, whatever, and if it was only growing income, see 33AB is a mixed income, but supposing if there is only agricultural income is fully exempt. So remove that particular income from the computation of the tax liability because it will be eligible for the purpose of exemption. Further friends, if there is any question on section 33AB, there is a sequence which I have already told you. In that particular sequence, this section 33AB, if there is any deemed incomes, like for example 33AB, there is a reserve maintenance condition, reserve utilization condition. If because of any violations, if there is any income which is coming under section 33AB as a deemed income, include it in the 33AB adjustment by itself. In other words, your sequence of computation remain the same. Start profit as per profit and loss. Do all your headless adjustment, then do 33AB adjustment. 33AB, even if there is any deemed income, 33AB you have to do that. 33AB is none other than, don't forget friends, it is growing and manufacturing. That means it is an incentive which is given with respect to the mixed category of the income. So 33AB adjustment you complete fully, and after that you do agricultural income adjustment, and after that if there is any set off, you have to do that particular set off. Then the next point is under business income chapter, friends, there are many assets which might have been used for the purpose of business purposes. Now we have one of the best example is like your depreciable asset. A depreciable asset used for the purpose of business purpose is subjected to your WDV calculations, and your WDV, in case if there is any sale price, you adjust it from the WDV. It's a very routine kind of situation. But there are also many other kinds of asset, for example scientific research asset, for which you get 100% deduction, and that particular asset is not included in your WDV. So that kind of asset, I mean, used for the business purpose, but it is not part of your particular WDV. If there is any sale of that particular asset, it is taxable. So general rule is like that to the extent of the business income deduction. In other words, this is one basic example. If it was a 15 lakh asset, the 15 lakh particular asset to the extent of the 15 lakh rupees will be a deemed income in case if there is any sale price which is more than 15 lakh of rupees, and excess if any will be regarded as the capital gains. However, if this particular asset was used for the business purpose and then you have sold it, for example scientific research is over and you had a building and that particular building is still there, but then you absorb that particular building into in your ordinary business, in that case then the asset will be added to the block of asset, but the cost will be nil. In other words, such assets if used for the business purpose, it will be added to the block and the cost will be nil, and thereafter if you sell it, the sale price had to be adjusted from the block. In other words, any assets used for the business purpose which was originally for the scientific research will be forming part of the block of asset if after the completion of the scientific research, the asset was used for the purpose of business purposes. Thereafter, this particular point that you already have is section 35 AD business. Section 35 AD business is, friends, one of the situation where there is a special incentive which is provided by the government for the specified businesses, where the capital expenditure, the specified capital expenditure is eligible for the purpose of deduction. Now you have to remember, if you want, you can pause your video here. The couple of questions we have already done on section 35 AD, have a look at it, and in that 35 AD you remember, and if you see the working of the answer, what is your eligible deduction, you have to make it as a working note. Okay, so whatever generally the capex expenditure which is in relation to the specified business, we are mostly coming into examination condition. Those capex expenditure have a different working, and current year like your P&L expenditure is provided to P&L and do headless adjustment. All those things that you already do. Wherever there is any asset, remember this is a general rule. Wherever there is any asset which is eligible for the purpose of some special benefit like 100% deduction, and say for example scientific is 100% deduction. Section 35 it is say for example 100% deduction. On those assets, don't give the depreciation. Never ever consider the double deduction. I repeat, never ever consider the double deduction to the assessee. In other words, if any cost of the asset is 100% allowed as a deduction under any provisions of the law, then on those assets, logically, friends, depreciation should not be allowed. So only thing what I'm trying to tell you is that see section 35 AD is eligible expenditure have a separate working, and there are a couple of questions that we already solved. If you want, you can pause your video here and refer to those particular dedicated question on that particular front. The next issue is, friend, the telecom rights. The telecom rights is basically are your intangible assets, specifically with respect to the telecom industry. The license fees which you pay to the government for the purpose of operation of the telecom services, that comes under section 35. It is basically your capex. But normally on the intangible asset will be eligible for the purpose of depreciation. But there is a special treatment which is provided under section 35AB. So if this is your intangible asset which is to acquire the telecom rights for the purpose of doing the telecom business, then there is a special method. It is cost remaining allowed has to be considered on the cash basis only. That means you will consider the cost, just like cost of the asset. So this will be cost of the intangible rights. That particular cost only upon the payment basis, which that you have to multiply with the fraction. The fraction is numerator is always 1. The denominator is the number of years for which the rights are going to be alive. So supposing if the life of the rights is 4 years, supposing, then the numerator is 1, denominator is 4, and that you multiply with the cost. Cost has to be considered on the cash basis, and the cost has to be considered remaining unallowed. That means cost multiplied by fraction, you will get the amount of the deduction. So if supposing first year you have paid 40, then 1/4 of the 40, assuming the life of this particular rights is 4 years, 40 multiplied by 1/4, so 10 is going to be the deduction. So the next cost remaining unallowed in the next year is going to be 30. So that particular 30 you multiply with the second year fraction, but now the second year the fraction is going to be 1/3. Why? Because now in the second year the life is going to be remaining only for the purpose of 3 years. So second year fraction will be 1/3, then third year will be 1/2, and last year will be 1/1. In other words, it is just the fraction concept. Cost remaining unallowed, multiply with the fraction, you will be eligible for the purpose of deduction. Further, the next point is Section 35(7)(7)(a). Basically, it is with respect to the deduction of the bad debts. This is a very important, friends. I expect that very good quality questions can come on this particular front. However, in the recent past, the real good coverage in the examination condition has not been given by the institute. Now, in this particular situation, friends, first of all, if you want, you can pause your video here and you refer to this couple of questions on the bad debts, the specific banks, financial institutions. The full-fledged questions that we have done, these questions are like your 10-mark questions. Some 3-4 questions we have in our data bank, and all the 4 questions, they are all good variety of the questions. Please go through that particular question. If you want, you can pause your video here and go through that particular question. Now the main point here is, friends, that the bank's financial institutions are given a special deduction under section 36(1)(7)(a). Some special situation is covered by 36(1)(8) also. In other words, under 7A and 8, certain percentage of income or certain percentages of aggregate advance made to the rural branches, which are defined under that particular clause, and that you have to multiply and be eligible for the purpose of deduction. Whatever that you claim of section 36(1)(7)(a), that is a specific deduction with respect to banks, financial institutions, that deduction you have to create a reserve. So that is a reserve creation condition. So year by year, friends, you get a deduction, you create a reserve. You get a deduction, you create a reserve. However, now in certain particular years there may be actual bad debts. That particular actual bad debts will be allowed as a deduction. Now the complication which comes is, what if the actual bad debt is more than what is allowed to as a deduction? So just look at this particular one question that I want to take it for the purpose of discussion. Say for example, you are having deduction as per section 36(1)(7)(a), as per the working is, say for example 8. Okay, so your actual deduction as per percentage calculation which is specified under that particular clause is 8. But supposing, friends, if you actually incurred a higher amount of bad debts, now you see our banks are now into very big losses. So there may be a situation where your actual bad debt, that means your actual losses, are much more than the percentage what is provided by the Income Tax Act. So can the excess over the specific deduction of 36(1)(7)(a) be allowed as a deduction? The answer is yes. In other words, 36(1)(7) is a general provision of the bad debts. I repeat, 36(1)(7)(a) is a specific provision for banks, financial institution. 36(1)(8) is also another type of specific provisions with respect to certain special financial institutions. Now those are the specific deductions. But if your actual bad debts is more than the specific what is provided under those specific sections, if the actual is more, the excess can also be allowed as a deduction. However, it should be monitored keeping in mind the reserve account also. In other words, in the past years, whatever the reserves that you have already created, if this particular reserve has a balance, that means say for example it has an opening balance, so to that extent your excess bad debt will get adjusted against the opening balance of that particular reserve. In other words, when you say that your actual bad debts is more than the percentage allowed of the current previous year, considering the previous year's balance, the opening balance of the reserve, thereafter you have to give the balance amount as a deduction. In this particular example, supposing the actual bad debts was 14, okay, and the current year specific deduction was, say for example 8, but the opening balance of the reserve was 1. So to that extent of 1, because reserve opening balance means that in the earlier years you might have got the excess deduction by virtue of the specific provisions. So to that extent, current year bad debts will not get the deduction. However, in the excess balance, that means if your reserve account becomes a debit balance, this is what I'm I'm just trying to say. That means if your reserve, because of the actual bad debts being more, that excess balance will be allowed to as a general deduction. That means if there is any actual amount of the bad debts, you have to analyze between how much is for the specific deduction, how much is towards the opening balance of the reserve, and how much is excess over that, and that excess figure over that is to be allowed as a deduction under the general provisions. You should see the couple of questions very importantly on this particular front that we have already solved it. Section 3618. The section 3618, friends, it is another very important area with respect to the financial institution. This particular section says that you have to create a reserve, and just by creating a reserve, the law is giving you the deduction. However, the reserve should not exceed twice the amount of the share capital plus the general reserves. That means if your reserve exceeds the twice the amount of share capital in the general reserves, then it's like your financial position is very strong. So after that, you will not get that particular deduction. You have to create a reserve and you get the deduction. However, this is a specific section. However, you have to consider the limit of twice the amount of the paid share capital and the general reserves. So supposing if you have a profit as per P&L, your eligible income is this. Of that, how much amount that you have transferred to the reserve, that is one of the limit. The specified percentage of that particular income you multiply, that is going to be a second limit. Your third limit is going to be twice the amount of share capital plus general reserve. So that is the upper cap. Beyond that, if you can create a reserve, but the law will not give the deduction. So this is your upper cap minus the opening balance of that particular reserve, because so many years you're already creating the reserve and taking the deduction under this particular provisions. So how much is to the limit of the twice the amount of the paid up share capital in the general reserve. To that extent is your logically serving as a limit minus the opening balance of that particular reserve. That means the current previous year, that much maximum or optimum rather you can transfer it. So your limit number 1, limit number 2, limit number 3 will be eligible for the purpose of deduction. However, this reserve has to be maintained, and if you withdraw any money from this particular reserve, it is a deemed income. But one thing that you should keep it in your mind in the examination condition, sometimes there may be excess transfer to the reserve in the year number 1. So excess transfer to the reserve is not eligible for the purpose of deduction. And if that excess figure is withdrawn back in the subsequent year for which you haven't got the deduction, that cannot be a deemed income. That means what can be the deemed income is whatever deduction that you have got it in year number 1 with respect to the creation of the reserve, and in the year number 2 if you withdraw that particular money, it's like a misutilization and it will be your deemed income. And that particular point you should remember it very, 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 very carefully. This is one another question, friends, we already solved with respect to the bad debts. In relation to the bad debts, simple formula or simple understanding is just like your book depreciation head and the tax depreciation less. Similarly, your book debts, that means you book bad debts what you have provided, all you add, and whatever is your tax bad debts as per the specific provisions that you have to less it. If you make this particular, if you just go through this particular question, almost all the bad debts provision for NPS etc., which may be as per the banking laws and this that, everything you have to add. So whatever that you have done as per the books of accounts you add, and whatever is as per the tax laws that you have to less it. And under the tax laws, when you are going to less it, you have to remember that first of all there is a specific percentage provided, 3617A or 3618 as the case may be. As per the specific percentage, you have to give that particular deduction. And if there is any excess bad debts, the excess can be allowed as a deduction under the general provision subject to the balance reserves as might have been appearing in the books of accounts. So that question data, I have to read it very carefully. Refer the questions here. I once again repeat, book bad debts add for the financial institution and the banks, and whatever is the bad debts deduction as per the specified percentage is less because of that particular specified provisions. Further, in this particular situation, some of the presumptive incomes, and one of the situation of section 44A is that you can be eligible for the purpose of transport business is eligible for the purpose of presumptive income, and there are number of vehicles test. Okay, so there is a 10 number of vehicles test, but sometimes it may so happen that this 10 number of vehicle, the ownership is anytime during the previous year. So during a particular year, you might have added some vehicles during the year, or you might have less that particular vehicle. So if you have sold first and thereafter you have acquired, so that is a better situation. In other words, the condition of the 10 vehicle is any time during the previous year. That you have to keep it in your back memory. So any time during the previous year, you should have considered that particular point. Now let's come to the presumptive taxation. The presumptive taxation, friends, that way it is very simple. That certain percentage of the turnover, the gross receipts you multiply and you are eligible for the purpose of the presumptive income. But in this particular situation, based on the tribunal's cases, it is very well understood that normally assessor is not supposed to maintain the books of accounts. But if you have already maintained the books of accounts, and if your books of accounts actually reveal the higher profits, I repeat, normally the books of accounts you have not to maintain, but you have actually maintained the books. and the books of accounts reveal a higher profit. In that case, if you want to be eligible for the purpose of presumptive income, you have to go for the higher profit. That means you have to pay a little bit of extra taxes to the government. Now, in the questions, friends, normally they will not print specifically that books of accounts are maintained, not maintained, but some specific data will be given. Now, for example, in this particular question, it is told to us that as per the profits is X number and depreciation would have been like this. So this means that, or it is indicated that the books of accounts are maintained. Actually, it is not required to be maintained. So what you do is you follow the presumptive percentage and you follow the actual amount. You have to make the comparison. That means if there is any such specific data given with respect to the presumptive incomes, you have to compute you have to analyze what is your actual income. That means as per the actual records, if you have maintained it. Say supposing you have not maintained the books, then the actual data only you will not have. There is no question of any comparison coming into picture. But supposing if it is available, so you have to compare it and then take the decision. If your actual profits are higher, I repeat, if the actual profits are higher, then such higher profits will have to be considered if you want to be eligible for the scheme. However, if you want to return lower profits, you can do that. But in that case, the scheme will not apply. You have to maintain the books and your books of accounts will have to be audited. The second important thing with respect to the presumptive income is that if there is any income which is given to you as if any income is being computed as per the presumptive scheme. So for example, this is in this particular question something like 49 lakh in some odd number. If you are offering this particular money to the presumptive scheme, then this particular money you are not supposed to ask any questions with respect to 66 unexplained cash credits, unexplained expenditure, your cash transactions, etc. So tribunals have said that if assessed is covered by the presumptive income and those transactions which are covered by the presumptive income, assessing officer should not ask for that detailed questions like explain the source and why cash transactions and why this particular disallowance and all that. So such situations should be refrained from. This is what the tribunals have said. So if I am following the scheme, it is logically concluded that the assessing officer cannot or should not make the additions with respect to section 68, 69, but with respect to those transactions which are part of the presumptive schemes. If you have other transactions also, for example, if your bank summary has been brought, if your bank account has been brought, and from the bank account if it is noticed that you have other transactions other than business transactions, so those transactions can always be subjected to very well questioning, and that you have to already answer. And if officer is not satisfied, he can make the additions in that particular regards. So 2 points with respect to the presumptive income. If the books are maintained and if your actual books are showing the higher profits, then follow the higher profits if you want to follow the scheme. And the second thing is the assessing officer should not ask section 6869 related questions with respect to those business transactions which are already covered by section 44 AD, ADA, etc. the presumptive schemes under the business income chapter. Now friends, with respect to the corporate taxation, the two of the most important area is one, your calculation of the MAT tax liability, and the second is the dividend tax obligations. First of all, if you want, just pause this particular video here and go through the MAT adjustments. That couple of adjustments to be added, couple of adjustments to be less. A couple of hardcore basic questions on the MAT that we have already solved. Please take a little bit of time, pause the video here if you want, go through those particular adjustments and what all additions to be made, add list of add adjustment, list of less adjustment. Okay. And thereafter, friends, the next thing that comes is the computation of your MAT tax liability. The computation of MAT tax liability basically works like that. You do profit as per profit and loss, which is as per the books of accounts. So as per the books of accounts, the profit will be given. You do specified add less adjustment. You get this particular book profits. On the book profit, you multiply the specified percentage, which is of the MAT, and get the MAT tax liability. Top it up with the applicable surcharge and the cess is your total tax liability under the MAT provisions. The minimum amount of the tax, I repeat, the minimum amount of the tax is the MAT. In other words, if your normal tax liability is lesser than the MAT, for example, if normal tax liability is 10 rupees, but if your MAT tax liability comes to 25 rupees, so MAT is the minimum figure 25 which you have to pay, and whatever extra that you are paying, the minimum is 10 as per normal, as per normal provisions it is 10, but as per the MAT you are supposed to pay 25, so extra because of MAT you are paying is 15 rupees. That is your tax credits to be carried forward to the subsequent year and will be eligible for the purpose of set off. In other words, this is a calculation of a normal calculation of the MAT tax liability. Just understand the basic example that this is your book profit, multiply with the rate of MAT, surcharge, etc. You get a total tax liability as per the MAT. However, under the normal total income, you have special rates of tax. In other words, in the normal total income, you may have suppose long-term capital gains, you multiply with the special rates of tax. However, in the MAT, there is nothing like special rates of tax. The MAT rate is MAT rate, which is covered by this particular chapter. Now, this you have to do the comparison that this your total income tax liability in the given situation is more, and your book profit is, say for example, less. So in this particular year, that is not a year of carry forward. In other words, if your book profit is more, that means you are paying more taxes because of the MAT, then it is a year of carry forward. And if your total income tax liability is more, that is a normal tax liability. So in this particular example, which you see it on the screen, it will be the case of a set off. The reason being that the normal tax liability is more. If you have available credit, you will be eligible for the purpose of set off. Now, one thing which I want to bring it to your notice very precisely, that in the year of the carry forward, supposing if your MAT tax liability is more than if you carry forwarding, the tax paid in the foreign country is not allowed to be carried forward. This is one of the hardcore aspect of the MAT tax credit. I repeat, if the taxes were paid in the foreign country for which you are taking credit in India, is not allowed to be carried forward. In other words, the current year set off for the foreign tax credits or foreign tax payments is allowed, but the carry forward is not allowed. So the carried forward of the tax credit, if your book profit is higher, tax on book profit is higher, it should be only of the Indian taxes and it should not be of the foreign taxes. The next good area of this particular chapter is your dividend tax provisions. Now, dividend tax, friends, is always going to be bit complicated, but it is that way very simple. The simple thumb rule that you better remember, friends, is that if the company pays the dividend tax, the shareholder will be eligible for the purpose of exemption. I repeat, if the company pays the dividend tax, then the shareholder will be eligible for the purpose of exemption. Simple as that, a simple rule. If the company does not pay the dividend tax, or if company is not covered by the dividend tax provision, then the shareholder will not be eligible for the purpose of exemption. This is a simple thumb rule that one has to follow, unless there is some specific provisions in that particular regards. Now, dividend is covered by section 222 A, B, C, D and E. Now, the dividend tax is applicable on 222 E type, that is a loan type transactions also. So here what I have already broken up. So 222 A, B, C, D also you pay the dividend tax, 222 E also you pay the dividend tax. So however, the rates of the dividend tax is different, and the dividend tax, there is something called the grossing up of concept. The grossing up concept is not applicable with respect to 222 E dividend type. So the company will pay the dividend tax, either it is 222 A, B, C, D or 222E, but in 222E the grossing up is not to be done. In 222 ABCD the grossing up is to be done. In that case, it will be eligible for the purpose of exemption in the hands of the shareholder. However, if there is any dividend from the foreign company, the foreign companies are not subjected to dividend tax, and therefore that particular dividend will always be taxable. So had it been the dividend distributed by a foreign company, there is no dividend tax, but foreign company don't pay dividend tax and not supposed to pay the dividend tax, and in the share and the hands of the shareholder it will become taxable. So it is a simple thumb rule, friends, that you need to follow. Now, friends, there is some extra adjustments. One is section 115 BBDA. So government has thought that if there is some big investor getting big amount of the dividends and the amount of the dividend is more than the specified limit of section 115 BBDA, in that particular case the excess figure will be subjected to 115 BBDA provisions. So 115 BBDA provision is a special provisions which is to be considered, but the 115 BBDA provision do not apply to section 222E type dividends. So do not apply. Look at this. So say for example that if I am a shareholder, the specified shareholder of the company, and if I get a dividend from that particular private limited company, that means as a loan I get it, but it is treated as a deemed dividend. So that particular loan figure can be very high figure, but still the 115 BBDA provisions will not be applicable in this particular situation. Then there is something called as the intercorporate dividend set-off subject to the conditions on merits. So that intercorporate dividend set-off is available, and whatever is the loan which is provided of 222, there is no intercorporate dividend set-off, but this is something called as a loan set-off adjustment. The couple of questions that I have already explained to you in my regular class, there is 222E loan set-off adjustment. Let me just explain to you in a very simple words. For example, the company, the private limited company has already given the loan. Then after giving the loan, say for example after 2 months, there is a normal dividend declaration. So normal dividend company has to pay, and company has to recover the loan also from the same to same specified shareholder. So company may not pay that particular dividend. The company has to take that decision. May not pay that particular dividend. Instead, it will adjust it against the loan payment which they have made it couple of months back. So if there is any such transaction done, there is a loan set off against the normal dividend. So that is a special adjustment which is to be carried out. So 222E dividend is subjected to such adjustments, which we call it as some dividend set off adjustment, and other dividends is intercorporate dividend set off, that is also eligible for the purpose of an intercorporate dividend set off that you should already study. Now friends, if you want, you can pause your video here for some time and refer to those few questions on the dividend tax, those dividend tax liability, how it is calculated, how intercorporate dividend set off has been, but these are very hardcore important areas from the examination point of view. So how this intercorporate dividend set off is done, how the dividend tax liability is calculated, how 115 BBDA provisions are integrated together with the calculation of these particular things in the hands of the individual shareholders. Variety of the questions that we have already solved, that you should better keep it in your back memory. Pause your video here, go through those particular few questions right now. Okay, now if there is any dividends from the foreign subsidiary, I repeat, if there is any dividends from the foreign subsidiary, then 115BB provision is applicable, where there is a special rates of tax. This is basically like an incentive to bring back the money back to India as a dividend from the foreign subsidiary. But only one thing that you should better remember is that this foreign subsidiary meaning for the purpose of 115BBD is a different meaning, and foreign subsidiary meaning for the purpose of intercorporate dividend set-off is a different set-off. Is a different meaning, sorry. So that particular interpretation where 115BBD and intercorporate dividend set off, that is a special questions that I have already solved with you. You better glance those particular question very immediately. Okay, so 115BBD is something which is very much important. Same thing, 115BBD provisions do not apply to 222E dividend types. Technically, if you read 115BBD, etc., the provisions exactly makes it very clear that this adjustment, these sections do not apply to the provisions of 222E. This can be very big important thing in the examination condition, and I've already solved variety of questions. Look up this particular points in the variety of the questions. Now friends, this is one simple example of your dividend tax obligations and your dividend set off and all that kind of things. So the company already declares a dividend, so this is how your answer will look like. So this is your declared, distributed or paid the amount of that particular dividends. However, there is 115BBD intercorporate dividend set off, but this is basically from the foreign subsidiary. So foreign subsidiary, for the purpose of intercorporate dividend set off, the condition is 50%. However, for 115BBD special rates of tax, it is 26%. So that you have to remember the meaning of subsidiary separate for separate meaning. Okay, so 115BBD dividend, 115BBD foreign subsidiary dividend is also subjected to intercorporate dividend set off, provided that the tax under 115BBD has already been paid. So this is one adjustment. Dividend from Indian subsidiary is also subjected to intercorporate dividend set off. Thereafter, if there is any payment made to the new pension trust or the entity on behalf of new pension trust, which is covered by section 1044 of the Income Tax Act, there is no dividend distribution tax with respect to that. So that particular adjustment is to be carried out. The loan set off adjustment, however, in this particular example is not there. So for example, this 1.9 rupees per share, which is to a particular shareholder, say for example, and to that particular shareholder, if that private limited company, if it has already given that particular loan, and if that loan is adjusted against, if it is adjusted by the company as a set off, then this particular adjustment can be done here. Thereafter, you have to gross it up. So grossing up of dividend concept, friends, is applicable for 222ABC. 222E, the grossing up is not required. Thereafter, you multiply the rates of the dividend tax and get the amount of the dividend tax liability. So this is the format in which you have to solve your dividend tax obligations. Now this is one example, friends, which I just bring it to your notice, where 222E dividend is not subjected to any grossing up. So if there was any loan given to the specified shareholder, you have to multiply the higher rate of dividend tax, because dividend tax with respect to 222E is a higher rate of tax, and you have to apply that particular rate and calculate the dividend tax obligation. However, if it is not 222E type dividend, the other type dividend, that means, say for example, this figure, this you have to gross it up. This is the grossing up which is required to be done. In other words, the message which I'm just trying to give it to you, that if there is a 222ABCD type of dividend, the grossing up is required. 222E, the grossing up is not required. Then you multiply the dividend tax rate. 222ABCD, the dividend tax rate is also lower. So rate of dividend tax is also lower. And 222E, the dividend tax rate is also higher. So you have to remember that particular dividend tax rate. So here it is, see, the 15%, here it is 30%. So that difference in the rates of dividend tax that you have to consider. And if you want, you can just take a little bit of time and go through these particular questions right now, the very valuable part of this particular discussion. Now friends, let me revise very quickly with respect to the assessment of the partnership firms. Friends, for the purpose of partnership firm, there is one special section under the business income, which is section 40 small b. Section 40 small b basically provides that the any interest or remuneration, salary, bonus, remuneration, commission to the partners will be covered by these particular provisions. There the basic conditions are to be satisfied. The basic conditions are the remuneration exercise should be to the working partner, should be authorized by the partnership deed, and the period of authorization should have been confirmed. Interest payment to the partners, interest payment made by the firm to the partner should be authorized by the partnership deed, and there is an overall monetary limit with respect to the remuneration. In other words, remember these hardcore basic things. The remuneration should be to the working partner, it should have been authorized by the partnership deed, and the period of authorization should also be within the range. That means if it is authorized from 1st of June, then from the 1st of June only the remuneration will be allowed as a deduction. Then there is a monetary limit with respect to the interest. The limit is 12%. That means beyond 12%, if the interest is provided, it will not be allowed as a deduction. The excess will have to be disallowed by the operations of section 40B, and the overall monetary limit with respect to all the partners' remuneration taken together for a particular year, which is based on the percentage of the book profits. I will tell you that particular thing. Any computation, friends, you have to do it. in relation to this particular partnership firm, you have to do it like that. Start with the profit as per P&L. Do all your add-less adjustment. Just like your book depreciation add and the tax depreciation less, similarly your book remuneration add, your book interest add, which is basically interest from the partnership firm to the partner. So it is a transaction between firm to the partner only, not any interest that you have to add. It is a transaction between partner and the partnership firm only that we are trying to discuss by virtue of section 40B. Now in this particular case, friends, you have to add the interest complete and you have to add the salary bonus remuneration combination completely. Just like your book depreciation add and the tax depreciation less, similar type of an adjustment. But here the sequence has to be kept in mind. First you have to add interest, add remuneration. So whatever is for the books, you have to completely add it. And thereafter you have to first allow the deduction on account of interest. And after allowing the interest, technically as per section 40B, where the other theoretical condition is satisfied, like it should be authorized by the partnership deed, maximum 12% is allowed. So let me assume that 12% is allowed as a deduction. So after giving 12% interest as a deduction, whatever the balance remains, that balance is basically called as the book profits. Book profit is a special meaning which is as per the provisions of the Income Tax Act, and this particular book profit, from the book profit you have to give the second adjustment, that is on account of the remuneration. Some people also call it as a last adjustment from the partnership firm is a remuneration, and the second last adjustment is on account of the interest. However, the interest could even adjusted otherwise round. In other words, the important thing is that your remuneration adjustment is after considering the interest adjustment, is one of the technical aspect of this particular point. Second important point is with respect to the interest adjustment, where a partner is a partner in a representative capacity. In a nutshell, in a representative capacity means if HUF wants to become a partner in the partnership firm, HUF normally cannot become, but one of the member, one of the co-partner of that particular HUF will represent the HUF in the partnership firm. So this is a very unique situation. And in this particular situation, friends, from the interest point of view, listen very carefully. From the interest point of view, the beneficial partner will be considered as the real partner. In other words, the interest payment to the beneficial partner, that means interest payment to HUF. So for example, if the HUF is the partner, technically HUF is never a partner, but the beneficial partner is the HUF, and the interest is given as a capital on the capital employed which is by the HUF, it will be subjected to the limit of section 40B. Remember this particular point very, very carefully. Technically, HUF cannot become partner. Technically, HUF is only the beneficial partner. The registered partner is always Mr. X in this particular situation. This creates a little bit of a confusion with respect to the interest payment. From the interest angle point of view, consider always the beneficial partner. That means person who employ the capital, that particular person will be regarded as a beneficial partner, which is HUF in the given case. So apply the limit of interest, section 40B limit, to such a partner who is a beneficial partner. That means the person who has employed that particular capital. Secondly, friends, this particular format has to be strictly followed. In other words, some of the questions in the examination condition will ask you only compute the book profits. Listen very carefully. So students should stop the answer if they ask you that only calculate the book profit. See, if there is any question on calculation of the book profit, normally it will not be a high value question. So sometimes to trick the students in the examination condition, the question will ask you that only do book profit. So if you thereafter do remuneration calculation and all that, then you are going to waste your time in the examination condition. So see the question very properly, whether they are asking you the computation of the book profit or they are asking you the computation of the total income. Accordingly, you give your particular answer. Okay. The next particular important thing is the basic format of computation, which I already explained, but let me do it with the help of a number. See, you start with the profit as per P&L. You have to add the complete remuneration. So complete remuneration as per the books has already been added. Whatever is the interest as per the books. So this is as per the books completely added. So you started with your profit as per P&L, add all partners remuneration, add all partners interest. Okay. Now the interest, when it comes, first you have to do interest as the deduction. Okay, so interest you have to provide at the rate of 12%. However, it should be authorized by the partnership. It is a maximum limit of 12%. If the partnership firm, the partnership deed says that no, interest should be provided at the rate of 9%. So authorization is only for 9%. Then you cannot take 12%. In other words, maximum cap is 12%. If the question don't print any data, you can use the 12% as a maximum cap as permissible interest, which is authorized by the partnership deed to the partner. One point that you better remember: it is interest payment by the partnership firm to the partner. In other words, it can be either on a capital account, it can either be on a loan account. I repeat, it can be on any account as long as it is payment by the partnership firm to the partner. So where a firm is paying to the partner on account of interest, then this particular provisions of 12%, that is our cap, with respect to the interest deduction, is permissible. So first you have to add it as per the book. Now this is your tax law deduction. as per the provisions of section 40B, and after that you get your book profit. So this is your book profits. On the book profit you have to apply the monetary limit. What is the monetary limit? The monetary limit is up to first 3 lakhs of the book profit. So this is your book profits. Up to first 3 lakh rupees, it is 90% of the 90%, and it is above that it is 60%. In this particular example, friends, it is only 2 lakhs some 89 or 89,000 rupees on account of the book profit. So it is not crossing the 3 lakh rupees. So we have just multiplied 60%. So 90%, because on first 3 lakh rupees it is 90%. So 3 lakh rupees multiplied by the 90% is your overall monetary cap. I repeat, it is overall monetary cap for all the partners and for the entire year. Okay, so this is your overall monetary limit taken together for all the partners and for the entire year is permissible limit, monetary limit for respect to the partners remuneration of that partnership firm. Compare it with the actual. Now see, in the actual, Mr. A was not working. So person who was not working is anyway not eligible for the purpose of deduction as per the tax law provisions. So the A is not working. So while doing tax law calculation, we will not consider him. Okay, and B and C, they were working, so they will come under the eligibility criteria. So their total is 1,32,000 some odd number, I think 1,32,000. Compare it to the limit of 90%, which is that is what is applicable in the given question, and see whether your 1,32,000 rupees, which is actual figure, whether it is within the monetary limits or not. And accordingly, you see now in this particular question, 1,32,000 is within the monetary limits, so that will be eligible for the purpose of deduction. That is a permissible remuneration deduction with respect to the partners of that particular partnership firm. Now think about the partner's point of view. That means that personal computation point of view. In the personal computation of the respective partner, friends, the most important thing is that whatever remuneration or whatever interest that the firm gets the deduction. I repeat, ladies and gentlemen, that whatever that the firm gets the deduction, only that amount is eligible for the purpose of taxation in the hands of the partner. I repeat, whatever interest or the remuneration that the firm gets the deduction, only to that extent it is taxable in the hands of the respective partner. Now, for example, interest, you see, the interest actually as per the books was 36,000 in this particular example. However, as per the limit was only 27,000 rupees. So, in the books of accounts, I have given a credit of interest to that particular partner 36,000. But how much will be the taxable income of that particular partner? The taxable income of that particular partner will only be 27,000 rupees. So this is what I have done the personal computation here, and to show you that what is allowed as a deduction to the partners of the partnership firm in the computation of the partnership firm, only that corresponding figure will be taxable in the hands of the personal computation of the respective partners. Now friends, think about remuneration. See, Mr. A was not working, so Mr. A's remuneration we have not allowed also. Here see, we have not allowed also, and that's the reason Mr. A, we have not given any deduction with respect to, we have not offered any amount to tax with respect to Mr. A, because Mr. A remuneration is not allowed as a deduction to the partnership firm. However, in the books of accounts, Mr. A was already provided. Look at this particular figure. So in the books of accounts, Mr. A will have a credit towards the remuneration, but the taxable income of Mr. A will not be there. Reason being that Mr. A's remuneration, because he was not working, was not allowed only as a deduction to the partnership firm. So in personal computation, it will not be covered. With respect to Mr. B and Mr. C, so they have this particular remuneration, and their remuneration was already allowed as a deduction, the corresponding figure in the computation of the partnership firm, and that is the reason it is included in the computation of the respective partner. And the last thing, the share of profits what they get. I repeat, the share of profits what they get from the partnership is already exempt under section 10. So the firm pay the tax on the profits, and that particular profit is exempt in the hands of the respective partner. So that I have already mentioned here. Whatever is the share of profit will be exempt. Share of profits will be exempt in the hands of the respective partner. Now friends, come to the next particular point, the book profit. Sometimes friends, this particular book profit really complicate to the students, and one of the complicated issue is the book profit adjustment. This book profit is technically as per the provisions of the tax laws, as per the provisions of section 28 to 44. This is a technical reading and interpretation of the book profit. In the math chapter, in the corporate taxation also, there is a book profit. So some there also the book profit. So where is the confusion? Remember one thing very clearly, book profit for the partnership firm is as per the tax laws. Book profit for the purpose of math calculation is as per the math chapter, that is as per the books of accounts. They have different meaning in different chapter. Although the terms which is used, the title term which is used is called as a book profit. Here it is as per the 28 to 44. In other words, 28 to 44 already includes section 32.2. That is basically your depreciation carry forward and set off. So basically the book profit has to be considered after the adjustment of the depreciation, if there was any carry forward set off of the depreciation, and this could really matter, and this particular particular point was very much covered in some past examinations, but recently they have not covered up in the examination to test this particular knowledge. You got to be very, very cautious. Some question on that I've already solved. A very simple briefing that I'm telling you. As per the carry forward set of chapter, first you have to do section 72 adjustment, and later on you have to do section 32 adjustment. Now there is another problem. The problem is that you want, for the purpose of book profit, only 32. For the purpose of book profit, you don't want 72. So what you have to do is a little bit of a notional working, little bit of a artificial working you have to do, because without considering 72 you cannot get 32. So if there was a carried forward business loss and if there was a carried forward depreciation, so first you have to consider section 72 and thereafter you have to consider 32. But for the book profit purpose, I have to put a cut on section 72. The reason being, for book profit purposes, I have not to consider section 72. So book profit will be adjusted book profit for the limit calculation, because your monetary limit calculation is done based on the book profits. So this is one very special adjustment that you have to keep it in mind with respect to the book profits. Institute can really rocket this particular point in the examination condition someday for a very, very high value situation. The next point, friends, in case if there is any presumptive taxation. So in case of a partnership firm, friends, if there is any presumptive taxation, there can be a situation that normally they are not supposed to maintain the books of accounts, but they have already maintained it. And this one is a bit confusing point with respect to the presumptive taxation. And I've already told you that if the books of accounts are already maintained, and if those books of accounts are revealing the higher profits, then you have to go for the higher profits if you want to apply the scheme. In other words, the tribunals have always explained, normally you're not supposed to maintain the books, but if you have maintained. So if there is a detailed question will never print that the books of accounts are maintained. So you have to rock it in your mind whether, oh, the books of accounts are maintained, not maintained. Now keep this in mind, tribunals have always said that bank statement, bank summary, your summary statements, etc. is not a books of accounts. The books of accounts has to be the formal books of accounts. So what you do is, you start with the profit as per profit and loss as given, then you do all the necessary adjustments. These are all the necessary adjustment which is printed in the examination condition. Whatever question print, do all the adjustments. Okay. Thereafter, you have to consider section 40B. This is on normal provisions, because this is not applying your presumptive taxation. Then you get this particular number. This is your business income. Now this particular figure is something what we call it as per your books of accounts, but books of accounts computed as per the tax law provisions. So it's not, I'm not trying to say it is a book profits like your math chapter. No, books of accounts profit, that means you have maintained the records, but it is converted into tax law adjustments, and it is a tax profits, taxable profit, but based on your books of accounts, the records that you have already maintained. Now this particular figure, friends, you have to compare it with your presumptive number. See, where there is a detailed question and if the books are maintained, that means you have a detailed data, you cannot ignore this particular detailed data because you want to do the comparison. Because see, otherwise if I can have an easy shortcut in the examination condition, that will be totally wrong. I can say that I don't want to follow the books. All the books are maintained, but I'll not do any computation. I'll just follow the presumptive taxation. I'll just multiply the percentage with the turnover and get my answer. But that will be a wrong answer. Why? Because if the books are maintained, you have to compare that book number, that means tax profit as per the books of accounts, and that means tax profits computed based on the books of accounts, and that you want to compare it with your presumptive income. And if the book number would have been higher, you want to go for the higher figure. So you have to do that particular exercise. Now friends, in this particular example, just the turnover figures were given, I multiplied the necessary percentage, and I straight away got this particular taxable profit. So I want to compare this profit, which is my presumptive profit, with my actual profit. So my actual profit in the given situation, friends, is how much? Some 4 lakhs, some odd number. Okay, so this is my actual profit, which is lower than the presumptive number. So what I do is, I write a note in the examination condition, and I say that, okay, I am going with this particular presumptive number. In other words, I am filing my return as per the presumptive number. So I am following the presumptive scheme because my actual profits are lower, and therefore the advantages of the scheme should be applicable to me. And this is how you have to conclude it. If there is any detailed question, do the presumptive computation and do the actual computation. Now friends, there is one more point that you have to remember, which is already there. If you want to pause the video, you do one thing. The couple of questions which we have already solved in the partnership firm, the full-fledged type questions, have a glance of them. Some 5-6 good quality questions. So just have a glance of them. No need to resolve it, but completely see that what you have already done it. Okay. And the important thing is that when you are doing the presumptive scheme, so this is my presumptive computation, section 40B is not allowed here. Okay, so in certain presumptive scheme, friends, section 40B is allowed. That means over and above the presumptive scheme, it is already allowed. So you have to have that particular knowledge. That summary points I've already given it in my regular class. When you will go through all that particular question, you will come to know that in certain situations, section 40B allowed, certain situation not allowed. So that you have to remember, that if this is the partnership firm and if there is a presumptive taxation, how this section 40B adjustment will have to be carried out. That notes is already there in our regular study classes. When you refer to these particular questions, we should take some time and go through these particular questions on the partnership firm. Now friends, let me just revise quickly with respect to the association of persons. Friends, association of person, the most important thing is the rates of taxes and the tax liability situations. In fact, friends, the AOP questions, whenever it has come in the examination condition, the students have always found it a little bit difficult to manage it in the examination condition. First of all, friends, before I go ahead, I request you that you can just pause this particular video at this particular point in time and just go through those couple of questions that we have already solved with respect to the AOP. And in that, most probably and most importantly, you see that how the tax liability calculation is done with respect to the AOP computation and how does that impact on the personal computation of the respective members. Because here, friends, whenever the question comes, by and large, they will also expect you to have the knowledge of how the personal computation of the respective member will come and how it will get implicated in terms of situation. Sometimes, friends, some of the questions in the examination condition, they will give you some indirect data so that you understand and you have to interpret the data and say that, oh, the personal computation of the member was supposing done like that, then the AOP would have been done like that, or vice versa, or some AOP adjustments were done like that. So logically, because of that, the impact will come in the assessment of the member. So with that, please go through this particular couple of questions that we have already solved. Focus on how the tax liability implication and the tax liability of the AOP and the tax liability of the member. They just have that side by side understanding very properly from the AOP point of view. Under section, friends, AOP section 167B is one of the most important section, and that particularly tell you about the rates of taxes. Here, friends, the concept of MMR comes into picture, maximum marginal rates of tax. The maximum marginal rates of tax is defined under section 2 of the Income Tax Act, which always includes the surcharge in the cess. I repeat, the maximum marginal rates of tax as defined under section 2 always includes the surcharge in the cess. Also refer, friends, the method of calculation of the MMR that I already told. There's a maximum rate applicable to an individual plus the maximum surcharge is applicable to an individual plus the applicable cess. When you top it up all these three things, you get something called the maximum marginal rates of taxes. Friends, in certain situations, there is something called as maximum marginal rates of tax as applicable. The AOP tax rate, friends, depend upon broadly if the share of the member is determined or the share of the member is not determined. That means, say for example, there are three members, X, Y and Z. If you say 20, 20, 60 percentage, this is already share determined. Supposing the question tell you the exact data that the share of that particular member, there are three members, example, and these three members are the share is like this, it is called a determined share. In that particular situation, this particular column, now this particular type of situations will come into picture. Supposing if this percentage data is not given and they have just said this is an AOP and they just share profit and losses, how they share, whether they share equally or otherwise, that is not clearly mentioned. So you can have a reason to believe saying that the share is not determined. Now if the share is not determined, friends, the law says that the tax rate applicable will be straight away the MMR. So here, the straight away, if the share of the members is not determined in AOP, straight away MMR. However, if any of the member of this particular AOP is subjected to the tax rate in their personal capacity, the rate higher than the MMR. Example, supposing in this particular Z, supposing was a foreign company. I repeat, supposing, friends, this particular Z was a foreign company. So in this particular case, foreign company, its personal tax rate is higher than that of the MMR. So there is any one member or more than one member who is chargeable at the higher rates of tax higher than the MMR. So basically you are comparing the rates of tax of the MMR and such rates of tax is applicable to that particular member of that particular AOP. In that case, the entire income will be subjected to such higher rates of taxes. That means the situation is either it can be MMR rate of tax or it can be higher than the MMR rates of tax is a situation if the share is not determined. However, if the share is already determined, that means this particular situation, if the share of this particular member is already determined, in that particular case, the test is if other personal income of any of the member is more than the basic exemption limit. That means, say for example, X, Y and Z. X, Y and Z are the three members. The Mr. X is, say for example, is getting his salary from some another source. And supposing his salary is 25 lakh rupees, which is of course more than the basic exemption limit. So that is one situation. So the personal income excluding the share from that particular AOP of any of the member, if it is more than the basic exemption limit, then the tax rate applicable to the AOP is the MMR. That means the tax liability, the tax rate of the AOP depends upon what is the personal income of that particular member if the share of that particular AOP is already determined. So don't forget the heading. So here also MMR provisions will be applicable. And if any of the member of that particular AOP, don't forget the heading. The heading is that the share is already determined. If any of the member is chargeable at the rate higher than the MMR, then to the extent of that particular member share, you have to multiply with such higher rates of tax, and the balance you have to multiply with the MMR rates of tax. That means in any case, the minimum is the MMR rates of tax, maximum is such higher rates of tax. The very simple example, because this different situation they can create in the examination condition, and they can ask you to calculate the particular tax liability. Now say for example X, Y, Z, the share is determined. The share of Z is 40%, okay, and the other people are sharing 30%, okay. Now this particular Z is, say for example, foreign company. So how will the tax liability of the AOP will be calculated? The 40% share will be multiplied with that of the foreign company, right? And the balance, I will not say 60%, I will say the balance will be multiplied with the MMR, okay. So to the extent of that particular member, such higher rates of tax, and the balance will have to be multiplied with the MMR, and this is how the tax liability of the AOP will get calculated. These are four broad situations. So two situations here and two situations here. So two situations where the share is not determined, and the two situations where the share is determined accordingly. And if you make the total analysis of section 167B, minimum rate is the MMR, and other rate is, that means in special situations it is higher, the minimum is MMR or such higher rates of tax. It's a concept of the AOP. However, in one situation where either of this particular situation is not applicable, which I call it as basically the fifth situation, okay. So I just say the fifth situation. Fifth situation basically means that if you are not covered by 167B, logically what kind of a situation is that? Logically this fifth situation is that, say for example X, Y and Z, the three members, all of them are poor people. That means all of them's personal computation, that means their personal income is not more than basic exemption limit, and they are all individual people. So this kind of situation is not covered by section 167B. So this kind of situation, three member, example three member, it can be two member, it can be four member also, but all of their personal income is less than basic exemption limit, and the share on that particular AOP is determined. So in that particular situation, the AOP will be chargeable at the individual rates of taxes. So the tax liability of the AOP depends on this particular situation, and the detailed question which I already told you that we should have referred it, we have already taken care of in this particular situation. The final message is that if the AOP, friends, is chargeable at the MMR or such higher rates of tax, that means if the AOP is covered by any of these situations, and this is 167B situation, in this particular situation, if AOP is chargeable at the MMR or such higher rates of tax, in that particular situation, the share of member in the hands of the member will be exempt, just like a partnership firm. But I will never call it as a partnership firm. But in that situation, it is exempt. But if the AOP is subjected to the individual rates of tax, that means this fifth situation, then there is a special rebate working which is to be done, and that particular one is covered by section 110 also. In that particular case, the share of this particular member will be included for the rate purposes. The another important thing is, friends, that with respect to the partnership firm, like you have the partner's remuneration, partner's interest or something like that. This kind of situation under the AOP, you do not get, I repeat, you do not get any interest deduction or you do not get any remuneration deduction. So the format of computation with respect to the AOP is that you start with your profit as per P&L. Whatever data is printed to you in the examination condition, add the complete interest, add the complete salary remuneration. That means this interest and this salary remuneration is not allowed as a deduction. At the same point in time, there you have to do the allocation of the share that I will tell you. But this particular interest has to be the net interest. In other words, if AOP has paid any interest to that particular member, so that is a transaction from the AOP to that particular member, or if there was any interest recovery which was done from that particular member, so everything is to be netted off. That means total interest transaction between the AOP and that particular member has to be reversed. That means that is not allowed as a deduction whatsoever. So the interest paid is not allowed as a deduction, and the interest if recovered from that particular partner is not to be taxed as income in the hands of that particular AOP. So completely add interest, completely add salary remuneration, whatever you want to say. This is another major technical computation difference between partnership firm and an AOP. In case of a partnership firm, the remuneration in the interest is allowed as a deduction subjected to the conditions of section 40B. However, under section 40BA, which is with respect to the association of person, the interest is not allowed and the salary remuneration is not allowed. Okay, and other computation is as usual. So do all the adjustments as usual, whatever the business income adjustment that might have been printed in the question, but interest and the remuneration is not to be allowed in computing that particular income. Put it differently, you will get a net total income of that particular AOP. I repeat, you will get a net total income, and this particular net total income logically, friends, already includes this amount of interest, logically includes this amount of remuneration. In other words, some people also understand, and this is very fair to understand, saying that the the members' interest and the remuneration is taxable in the case of an association of person, or put it differently, that is not allowed as a deduction. That means logical imagination, friends, whatever is your net total income of the AOP already includes the disallowance of the interest and the remuneration. Then you have to do the allocation. The allocation in between the members. This allocation is very important from certain adjustment point of view. I will tell you in just some time to go. So to the extent of that particular interest, you have to consider the interest in the hands of the respective member. To the extent of the salary, you have to consider in the hands of the salary. That means how much salary, remuneration, etc. each of the member has got it, you have to allocate it. How much actual interest that they have got, you have to allocate it. Whatever is excess. So what is excess? Your total income allocation. This is what I am just trying to talk about. Your total income. Total income basically means your tax income. I'm not talking about as per the books of accounts. Your total income is 4,19,000 and some odd number. This 4,19,000 has to be distributed in between these particular members for some rate purposes, if at all the rate purposes are required. So it is important to learn this particular allocation very precisely. To the extent of interest, add interest. To the extent of remuneration, salary, bonus, etc., add it. And whatever is excess, we call it as a share of profit actually. That particular share of profit, you have to do it in the ratio of their profit sharing. I repeat, that will have to do it in the ratio of their profit sharing. So that you have to add it. Okay, and the total, so how much is for Mr. X, how much is for Mr. Y, and how much is for Mr. Z, this particular working that you will have to do it. Why this particular working is to be done, particularly reason why I am just telling you. Supposing if it is a fifth situation, then fifth situation means that supposing the AOP is subjected to the individual rates of tax, then the respective share of the member has to be included for the rate purposes in that particular computation. So supposing if you have to do the personal computation, in the personal computation of X, Y, and Z, how much was the share? Supposing this Mr. X 50,000 and some odd number, I can't see that with a very tiny handwriting. So that number has come from here. Have a look. This is allocated number of Mr. X, 50,000 and some odd number. So this is the allocated number of Mr. X that is already included. Listen very carefully. That is already included in the computation of Mr. X. Why it is included? It is because in this particular adjustment of the question, AOP is paying tax as per individual rates of tax. So if the AOP is paying tax as per individual rates of tax, this figure is included for X, similarly for Y, similarly for Z. But it is included for the rate purposes. I repeat, it is included for the rate purposes. And in other words, whatever amount is included, you have to average out this particular tax of this particular respective personal computation of the respective members, and therefrom you have to give the rebate on the average rate of tax. So there is a rebate working, friends, that whatever the tax liability comes on the total income, you have to take the average, and this particular figure which is included for the rate purposes, that particular figure is to be multiplied with the average rate of tax, and this is the amount of the rebate. So it is first included logically, and the tax on that particular figure is excluded. This is what we call it as for the purpose of rate purposes. So I'm not trying to say that this will be straight away taxable, but this is included for the rate purposes. That means this is the indirect way of bringing it to assessment some small little amount of the taxes in their personal computation, and this is what it is trying to say. It is included for the rate purposes. If you want, you can just pause this particular video here and just go through this particular working, which you have already done it in detail in variety of the questions in the questions of an AOP. Okay, now the next particular point that you should very small little point, but that you should keep it in your mind, but it is a repetition. It is just the format of computation. See, this was one of the examination type questions, small little looking answer, but this can by itself carry some 6 or 7 mark situation. So you start with the profit as per P&L. That is the beginning point. You have to increase it by the remuneration. So remuneration of that member for the AOP is not allowed as a deduction. Interest, if any, you have to adjust it. So these are the two main adjustments. All other adjustments are, friends, are normal business income adjustments. Like, for example, book depreciation, tax depreciation less, other expense disallowance, interest, revenue, capital expenditure, etc. kind of adjustments. So whatever, all business income adjustments are to be done as usual. But on top of that, interest you have to add, remuneration you have to add. So your gross total income will increase, of course, to by that extent. In other words, that much amount will become taxable. And similarly, by doing all your chapter 6A deduction, you will get a total income. So add the remuneration, add the interest, get the total income. On the total income, you have to calculate the tax liability. Now, one thing that you have to remember, if the AOP is covered by the special rates of tax. Now, for example, if some income like long-term capital gains is included in the computation of the AOP. So for special rates of tax, you have to apply special rates of tax. That means, see, if the AOP is multiplied with the MMR, for example, so you will say that, okay, MMR provisions will be applicable, no doubt about that. But in your total income, in my example, some 8 like an odd number. If some figure was long-term capital gains, for example, so the long-term capital gains, I'll multiply with the long-term capital gains tax rate. And the balance will be multiplied with the MMR if it was covered by section 167B. So this particular example is where the MMR was applicable. That means the situation was covered by section 167B. However, plus it had some special rates tax income. So that special rates tax income will go with the special rates, and the balance, if any, will be multiplied with the MMR. Depending on the quotient fact, if it is higher than MMR, then apply that particular higher than MMR rates of tax has to be applied in case of an AOP. Don't forget, friends, if you want, you can again pause it here a little bit and refer to all the questions. No, you don't need to do the repeated working, but observe the tax liability working for the AOP and the consequential effect in the hands of the personal members. Keep it in your back memory and go through those particular questions very importantly. Now, friends, let me quickly revise the provisions of the AMT. Friends, AMT working tax liability calculation is similar to the MAT provisions, but here the method of calculation is little bit different. See, for the corporate entity, it is provisions of the MAT which is applicable. For a non-corporate entities, the provisions of the AMT is applicable. So, the AMT provisions is to be applied with respect to the non-corporate entities. Now, let's say that, for example, a partnership firm. If there is a partnership firm which is claiming the specified eligible deductions which is provided for the purpose of AMT, and these are your adjustments, okay? Any deduction in the chapter 6A under the heading C, ATH to ATTT except section ATP provisions, etc. So whatever are the headings which is provided here, these are to be disallowed. In other words, for the AMT purpose, it is something like a disallowance. I mean, it has got nothing to do with the books of accounts. So you start with your total income. You start with the total income as per the provisions of the Income Tax Act. Add if you have claimed this particular deduction. Now just imagine if there is some assessor who is not covered by any of this. That means assessor is not covered by 10AA. Assessor is not covered by the specified chapter 6A deduction. Say for example. So such assessors will not have that AMT applications by itself. So AMT application, friends, is applies only if that particular non-corporate assessee is claiming this particular deduction. If somebody is not claiming, now for example, I'm an individual and I'm an individual not claiming either this specified chapter 6A deduction or section 10AA or that particular section 35. I'm not covered by that kind of, I'm a chartered accountant. I'm not covered by any of those provisions. So for me, AMT will not come into picture at all. So what you just do is just start with the total income, add that particular figure, then do the tax liability on the AMP. The tax liability working is very much similar to the MAT in that particular situation. You multiply by the rates and get the amount of the AMT. Other mechanism is almost the same. Like MAT is minimum alternate tax. This is alternate minimum tax. So basically like your tax credit, tax calculations, comparison with the normal tax liability, everything remain the same. How does your answer look like? See, your answer will normally look like your normal business income computation that you have already done it. Under business income, here in this particular question, you have already got that section 35 AD kind of a provision. You do the normal calculations. Okay. So by doing the normal calculations, you will get this particular total income. Okay. On this particular total income, in this particular total income, you will have to add for the purpose of AMT. So you have a total income, this particular figure. I will add the specified deductions that I'm talking about. Okay, so this is my AMT adjustment. Look at this. This is my AMT adjustment. So I have computed my total income in the normal way by claiming the necessary deductions. My total income, my tax liability is already calculated. This is my tax liability one. But for the AMT purpose, I again start with this particular number, which is my total income as per the provisions of the Income Tax Act. And to that, I will add this particular specified deduction, get this particular figure, do the AMT calculation by multiplying the tax rates and the tax liability calculation that I already explained it to you with respect to the AMT, and compare compare this particular tax liability and get the answer. If you want, you can just pause video, some couple of questions that we have solved, just see that how this tax liability multiplication, all that, which so many times which you have already practiced into our regular class. The next topic which I want to just quickly revise is the assessment of the trust. Friends, the trust are basically of two types. One, it's a private trust, and the second is a public trust. It is also called as a charitable trust. See, private trust is trust which is created for the benefit of some specified individual. For example, father created a trust for the benefit of his two children. This is perfect example of a private trust. And the public trust, the charitable trust, a trust created, say for example, for the benefit of women, children, blind, handicapped, etc. situation. In other words, it will be the class of persons. This is what we call it as a charitable trust. It will not be the specified individuals, and accordingly it is to be considered. A private trust is always taxable. A public trust, that means a charitable trust, is not taxable, subjected to the conditions of section 11, 12 and 13. First of all, friends, let me quickly revise your tax liability or the tax rate calculation with respect to the private trust. Now you have to imagine that there is a father who has created a trust for the benefit of two children. Now if the share is determined or the share is not determined, there are two situations broadly which is coming into picture. So section 164, which talks about if the share is not determined, and section 161 in general, what if the share is determined. These are the two broad criteria from the private trust point of view. I repeat that, say for example, there is a trust for the benefit of two children of the father, and the share of these two children, supposing 50-50 percentage. If this 50-50 percentage is defined in the trust deed, that means it is already identified, and then the situation will be, what if the share is determined? And supposing if this particular percentage is not identified, then the situation will be that this particular share is not determined. Okay. Now, if the share is not determined, then straight away the law says that you will have to multiply MMR rates of tax with respect to that particular tax liability of the private trust. MMR rates calculation I have already explained it to you in the past. Okay. So it is the maximum marginal rates of tax. But if the share is determined, so section 161 comes into picture. In that particular case, law specifically does not say just like the beneficiary. I mean, it is a very long and the technical and the specific language of the law, but the ultimate conclusion, it is just like the beneficiary. Just like the beneficiary means, supposing if the beneficiary is individual. So we said that father created trust for the benefit of two children. So two children are individual. So tax rates of the individual will be applicable to that particular trust. I repeat. In other words, the tax rate decision, because this is ultimately with respect to the tax liability calculation. The tax liability calculation will be done just like, I repeat, just like the beneficiary. Just like the beneficiary in the sense that beneficiary individuals, individual rates of tax. Supposing the beneficiary was an Indian company, then Indian company tax rate. Supposing the beneficiary was a foreign company, then the foreign company tax rate. So it depends on who is the beneficiary. There is one more permutation to this particular tax liability calculation, and that is section 161(1)(a). If the trust has got a business income, I repeat, if the trust has got a business income, that means if it is a business doing trust, then to the business income, you have to multiply the maximum marginal rates of tax. In other words, whether share determined, not determined. So that is two separate criteria. Now it's a different third angle of the tax liability calculation. If the trust has got a business income and it is a business doing trust, then the business income will have to be multiplied with the maximum marginal rates of tax. The opinion here taken is that to the extent of the business income multiplied by the MMR, other income you see whether share determined, share not determined. Accordingly, you have to take that particular decision. However, to this there are certain exceptions. Okay, so these are all what is provided is the exception in the respective provisions. That exception I have already explained in my regular class. Some questions also I have already solved on that. If you want, you can just pause your video, use this particular exception. But a simple message I'm just telling you. Supposing if you are covered by the exceptions, that means if the share is not determined and if you are covered by the exception here, for example, then what rates of tax will apply? Then the rates of tax of the individual will apply. And remember always, the MMR is always going to be the maximum tax liability in the practical situation. Individual tax rates may reduce the tax liability. So if you are covered by the exception, then you have to multiply the tax liability with the individual rates of taxes. I repeat, you'll have to multiply the tax liability with respect to the individual rates of taxes. On this also, I've already solved some of the questions here in our regular class. Please go through the answer of that particular questions in that particular situation. Now, friends, come to the public trust. In case of a charitable trust, friends, the computation of income is done like income, accumulation, and then application. So, for example, the section 11, 12, 13 in toto going to give you some sort of an exemption. It simply says that if your income is, say, for example, 100, if your income is 100, you can accumulate 15. That means your retained earnings can be 15%. However, it can be less also, but it's an up to 15%. And the balance is to be applied. It is to be applied for the object of the trust. That means it is basically for the charitable purposes. So, for example, if your trust is for the benefit of the blinds, then you have to use this particular money for the benefit of the blinds. If you are already using full 85 for the benefit of the blind, then the taxable income is nil. But say, for example, you are doing a short application. You applied only 60. So, this difference, 85 minus 60, 25 is going to be your income chargeable to tax. What rates of tax normally apply to the charitable trust? Normally, individual rates of tax apply to this particular charitable trust. That means you have to give basic exemptions, step 1, step 2, and do the tax liability calculation with respect to this particular charitable trust. Now, how is this income calculated? For example, it has got donors. For example, it has got a donation, corpus donation, non-corpus donation. It might get interest income, dividend income. It might have got other ancillary income, some small little rental income if it has got some halls or etc. So different varieties of income, whether it is included here. For that, I have already given you one particular chart here, which look on this particular screen, and that is already given it to you in the regular class also. So if you want, friends, first of all, you pause a video here, and by pausing, see how this particular income adjustment, what all point by and large included in the income. Thereafter, application you see. So here somewhere here, see amount to be applied. This part of the discussion is somewhere for the application where what all are the adjustment. For example, application of the income can be revenue, application of the income can be capital. For example, if the asset acquisition is done by that particular trust is, say, for example, a hospital. So I acquire a hospital building, and that acquisition of the hospital building is also the application of the income. Application is basically the use of money for the practical purposes. So with respect to that particular application, there are certain special adjustments, some of the special provision. Sometimes the monies are accrued to the charitable trust, but it is not received. So if I have just accrued, so I don't have money to apply basically, that means I cannot use that particular money. There are some special unique situations. So those are governed by some of the specific provisions. Some 4 or 5 good adjustments are there on that particular front. So some 4 or 5 important points from the income point of view already printed and given it to you. Some 4 or 5 application adjustment already given it to you. And so go through, just pause this particular video. In this particular page, I mean a very good summary of the entire computational aspect of this charitable trust has been given to you. If you want to, please pause this particular video at this point in time and just go through this particular point first of all. The next point which comes from the charitable trust point of view is basically your anonymous donation. Wherever the question, a difficult question has come in the examination condition, there is an anonymous donation adjustment which has come into picture. The anonymous donation is basically a situation where there is a donor. The donor has given the donation to this particular charitable trust, but the identity of the donor is not known. For example, somebody has given a big amount of donation to this particular charitable trust, but donor has not given his name, address, PAN number, etc. That means it's like something like a secret donation, something like a very quiet kind of a donation. The name of that particular person is nowhere. So such donations are not accepted by the law says that no, this kind of donation will be taxable as special rates of tax. So it says that it is very good in real life to make anonymous donation. That means you should not make donation with the intention for you to become more and more popular and kind of situation. So popularity is not something that should be kept in mind. So it is good, but from the tax law point of view, the government disclosure should always be made that who is bringing that particular money into that particular charitable trust. So that identity of the person should already be known. So if that is not there, so this particular type of donation will be taxable as special rates of tax under section 115 BBC. But 115 BBC says that there is a small little limit kind of, that means small, if it's a small amount of the anonymous donation, then they may excuse you and they may say that okay, we will not multiply with the special rates of tax. That small little working you have to do. So whenever, friends, a difficult to difficult question has come in the examination condition, anonymous donation has always come. So by and large, this is a very good area of the calculation. So anonymous donation says the limit is 5% of the total donation, that is somewhere here, okay, or rupees 1 lakh rupees. So that is your limit here, 5% of the total donation or 1 lakh rupees, whichever is higher. So logically it says up to 1 lakh rupees, we are not going to multiply with the special rates of tax. So in the given situation, supposing if your total donation was 5.75, okay, and your anonymous donation was 3 lakhs. So total donation was 5.75, multiply with the 5% is one of your limit. 1 lakh rupees is another limit, whichever is higher. So 1 lakh rupees, this will be not covered by section 115. That means this will be covered by the basic limit of section 115 BBC. Your total anonymous donation was 3 lakhs. So 1 lakh rupees is not covered by 115 BBC and balance will be covered by 115 BBC. So in this particular example, your total anonymous donation was 3 divided into 1 and 2. 1 is within the limit of 115 BBC and 2 is something which is excess over the limit of 115 BBC. Now here, friends, you have to remember, some people have a misconcept. They say that what is not covered by 115 BBC is not taxable. It is not like that. See, 115 BBC not applicable means the special rates of tax not applicable. 115 BBC is all about special rates of taxes. So it will be taxable, but under the general provisions. The special rates of tax, the special tax liability calculation will not be done. So when you do this particular calculation, this 1 lakh rupee, I will consider it as like a normal donation. Listen very carefully. So when I consider that particular 1 lakh rupees like a normal donation, that 1 lakh rupee will go for the 15% accumulation. So 15% accumulation I will do, where I will already include 1 lakh rupees, and 2 lakh rupees which will be multiplied with the special rates of tax, that I will include it after doing the adjustment of 15% accumulation and the application. That means I will add this particular 2 lakhs at the bottom, because that particular money will be straight away multiplied with the special rates of tax. Now a small little piece of the controversy is that whether this particular 1 lakh rupees will be subjected to that 15% accumulation or not. And institute also has always given the notes whenever this particular point has come in the examination condition. So the alternative answer, you may not write that in the examination condition because that will amount to the extra spending of the time, but you just write a note saying that this 1 lakh rupees included, saying that it is eligible for the purpose of basic, eligible for the purpose of accumulation and application. However, alternatively, it may not be included. But for classwork purpose, we say that 1 lakh rupees will not be included for the purpose of accumulation. That means I am not going to accumulate 15% out of this particular money. Instead, 1 lakh rupee I will straight away include it after the accumulation income adjustment has already been carried out. So ultimately, it is just that 15% accumulation out of this 1 lakh rupees, which is the basic limit of 115 BBC, the small little grey area. Otherwise, the answer between these two adjustment is going to remain the same. So, two opinion already exist. One, the amount which is covered by 115 BBC, the basic limit, whether that will be eligible for the purpose of accumulation or not, of 15%, that is a little bit of a grey area. You have to write a clear-cut note and apply this particular situation. Now, anonymous donation special rates of tax will be applicable, and other income will be multiplied with the normal rates of tax. So say for example, if you want to do a tax liability calculation, now it's a different example. So there may be there may be a situation. Now that anonymous donation is over, friends. If you want to calculate the tax liability of that particular charitable trust, then normally the tax rates of the individual, means basic exemption, etc. is applicable. So if your income is this, whatever is eligible for the normal rates of tax, that means individual rates of tax, you give the basic exemption slab 1, slab 2. So here it goes for the basic exemption. But if there is any income which is subjected to the MMR, that is the maximum marginal rates of tax, that you have to multiply with the MMR of your respective year, that you should always consider that. So don't see that this particular rate is rate to your particular, you should know your rates of tax. So don't see this particular screen, oh, this is the rates of tax or something like that. Refer to your notes, the latest rates of tax which I have already given it to you, that latest rates of tax that you have to consider in any of these situation. Okay, and this is your tax liability calculation which has already been carried out. Okay, now this is one of the another good area with respect to your capital gains of the charitable trust. Now this particular type of question looks very simple and straightforward, but since past many examinations, it is not tested in the examination condition. So I consider this particular point as a very valuable point, because it can sometimes come as a surprise as a computation of the capital gains with respect to the charitable trust. Now supposing the charitable trust would have got any capital gains, so you have sold that particular asset, so there is a cash inflow. So when there is a cash inflow come into picture, you compute the capital gains normally. So sale price, cost, expenditure on account of transfer, total, and the capital gains. So this much of the capital gains is very simple and straightforward part of the computation. There is no big deal whatsoever. But under section 11(1)(a), this particular section, the law says that if you reinvest the money, then reinvestment, that means reinvest in the sense that now here you have to use the money for the charitable purpose, because it is a charitable trust. So you reinvest means you reuse this particular money for the charitable purposes, will be eligible for the purpose of exemption. But here there is a special method, that how much excess over the cost that you are reinvesting. That means 2 lakh rupees is your cost. Look at this. So how much in excess of rupees 2 lakhs, because 2 lakh is your cost, that much will be eligible for the purpose of exemption. Now in the given case, he has the trust has already reinvested 2 lakh 10,000 rupees. Your cost was 2 lakh rupees. So how much is excess? Excess is 1 lakh 10,000. That much will be eligible for the purpose of special exemption under this particular clause. There is a small little grey area with respect to the charitable trust capital gains computation also, and that small little grey area is, if there was a long-term capital gains and all that, should you be eligible for the purpose of indexation or not? In other words, the computation of the capital gains, or rather the computation of the charitable trust, is normally never done headwise. That means, see, the computation of the charitable trust is more like a fund flow. I mean, I should not say the fund flow, but it is more like a fund flow. It is a fund in how you have applied that particular funds. So normally the heads of income hardly matters in this particular situation. So that's the reason there is some lot of a gray area, that supposing if it was a long term, should you index the cost or should you not index the cost? I suggest you that you should not not index the cost. But in any situation, the divergent opinion exists because of the technical interpretation of the law. You should always write a suitable note here, whether you are giving indexation, not indexation, whatever you want to do, just justify that, saying that supposing if you are not following the indexation, then say that you have followed the commercial principle. That means you have computed the income as per the commercial way, not as per the heads of income or something like that. And thus the artificial adjustment of the indexation has been ignored in this particular situation. And if you do it headwise, then say that the computation of the capital gains is done headwise, considering the language of section 11(1)(a), and alternative you also exist. Like this, you have to write that particular note in the examination condition.